Welcome to Chapter 6, Corporate Reporting. An important chapter for us in terms of your success in this exam. It includes an area that I would certainly include in my hot topics, probably my top 5, certainly my top 10 integrated reporting. Let's take a look at the first area. And in essence, when we think about reporting to shareholders, I think the first thing to think about is really the objective of doing that. And clearly, that's about providing relevant information. We know that shareholders and indeed stakeholders are important to the business. And indeed, shareholders as owners, have a right to receive accurate information. In other words, accurate reporting. All stakeholders will use the information that we provide them with to make important decisions. In terms of guidance, the OECD do provide us with some information in terms of disclosure and transparency. Let's take a look. The suggestion here is that the CG, or Corporate Governance Framework, should ensure timely and accurate disclosure is made on all material or important matters regarding the corporation, including financial situation, performance, ownership, and indeed governance. So in essence, what we're saying here is that corporate reporting and indeed the CG, or Corporate Governance Framework, is designed to provide information to help stakeholders. Stakeholders need information to assess the company, to perhaps assess their own situation in terms of their shareholding, etc., etc. Now, in terms of, let me just go back one bit. In terms of, the advantage, outside of what I've just said and indeed the guidance from OECD, there's clearly a number of advantages to good disclosure or indeed transparent or open disclosure. The bottom line is that in essence, shareholders have rights, and they have rights to be properly informed so that they can make decisions. Leaving shareholders aside, certainly society has rights also in order to sort of understand an organization, what it's doing, and indeed how that organization is affecting society and indeed the environment. Outside of that, when we think of sort of company reporting and indeed corporate reporting, we think of a number of different types and indeed styles of reports. These are just some examples up top here. I mentioned at the outset integrated reporting, sustainability reports, reports about how a company is using and or preserving the world's natural resources. Environmental, in other words, impact on the environment, perhaps in terms of emissions, waste, etc. Governance, how the company is being managed in some way and indeed directed and controlled for the benefit of shareholders and indeed all stakeholders. Reports on remuneration, a key area, obviously. Directors need proper remuneration, but this needs to be controlled. And indeed, outside of that, information in relation to corporate websites, information that's disclosed on sites in relation to companies. Is it accurate? Is it fair? Etc., etc. Outside of that, certainly there are two types, I guess, if you will, of reporting. The first part is mandatory. I'll take you through that in a moment. But over and above that, companies can report on a voluntary basis. Why would they do that? It's more work, more time, more cost, etc. Well, to provide additional information. Obviously, there is a caveat there, because where reporting isn't mandatory, where there isn't a standard, then certainly we have to be careful about what we sort of surmise in relation to information that a company voluntarily provides us with. So in terms of the mandatory area, a variety. We're familiar with the Companies Act, certainly in the UK and elsewhere. Sarbanes-Oxley in the US, governing corporate governance. We're also familiar with standards, accounting standards via the IFRS. Stock exchange requirements for listed companies are many and indeed varied. And over and above that, obviously, we have broad corporate governance codes. Let's think, for example, about the UK code. So there are a variety of sort of mechanisms in the environment, in the business environment, and indeed elsewhere, that sort of govern reporting, that assist sort of report makers, as it were, and indeed guide them, but also provide, rigid rules. What about the voluntary side? Well, voluntary, as mentioned, is a sort of a mixed bag. What do we mean by voluntary? Well, really, any disclosure that's sort of above the minimum, any disclosure that is in effect not mandated, not required. Now, generally speaking, when we think about voluntary disclosures on behalf of bodies, whether they listed or not, generally they're narrative rather than numerical in nature. Why is that? Because I think that it's easier to gauge narrative reporting rather than numbers, and there would be an issue certainly in relation to numerical reporting in terms of reliability, etc. Moving from there, when we think about policies or reporting policies, in different organizations, different companies, not-for-profit, for-profit entities will have different approaches. But broadly speaking, the requirements are to some extent impacted upon and influenced by the relevant stakeholder. So, for example, when we think about customers, and this is just one area, will be interested in a variety of things, but certainly one of them will be sort of social and indeed environmental activities and the impact of the organization's activities on the environment. This is key information. I mean, broadly speaking, in the last sort of 20 to 30 years, the public, customers, just about everyone has become more and more informed about the impact of organizations on a variety of different areas, of which social and environmental is just one. What about institutional investors? Well, certainly, as we've seen in other parts of this particular course, institutional investors are, broadly speaking, acting on behalf of their own clients and indeed their own beneficiaries to really ensure that companies are well run, and indeed that there is a return to their members based on their input and their shareholding in various listed and indeed other entities. Outside of that, what do they want? Well, broadly speaking, I guess more information in this area, strategy and indeed risk assessments. In terms of society, as mentioned up top, the impact of organizations and businesses on society is critical. People are more and more informed and more savvy now. So really, in terms of society and reporting, I guess more of this, more on social, more on ethical, more on environmental matters. And those are just some examples. Now, in terms of the ACCA do provide us with some useful information in terms of standards in this area. November 2021, the ACCA issued the following sort of reporting standard, as it were, and it's very, very comprehensive. Now, this is probably a little bit sort of OTT or over the top for an exam, but it's certainly quite useful to take a look at the ACCA's view on reporting and, broadly best practice. So what do they say? Well, in essence, they talk about covering or reporting to cover a broad scope of topics, that sort of highlights the interactions between the value that organizations create for themselves and the impact. So really, in terms of number one there, it's about balance, isn't it? The ACCA realized that for-profit organizations have a duty, indeed the directors have a duty to the shareholders to get a return, but they also have a duty to society and indeed the planet. So really, in effect, what point number one says is, yes, report on value, the value that you create, but also report on other important areas. Next point here is, be based on a common language and clear definitions. What we don't need within reports, according to the ACCA, is any sort of ambiguity. To use understandable, simple, common language and indeed clear definitions. In terms of number 3, they suggest that reporting, broadly speaking, should, have some sort of balance between principles-based, for example, in relation to corporate governance, and indeed, providing a minimum core set of comparable metrics. And when we say comparable metrics, we're talking about the ability for an organization to produce metrics that can be used to compare that organization, perhaps in terms of its emissions or other areas of importance, to other organizations. Number 4, this is an interesting one, avoid disclosure overload. So in essence, make sure that the presentation and indeed content of reports, is easy to use. What we don't need is too much information. We need the users of the report, perhaps society, other stakeholders, that be able to easily access the information that they're looking for. Point number 5 is the old cost v benefit issue. Clearly, if we are reporting, perhaps on a voluntary basis, businesses do need to balance the cost and benefit. Number 6, there's a suggestion here about a sort of a building block approach. In essence, what we're talking about there, if we think about IFRS, we have a set of standards, and really what we need to be able to do is to sort of build from a base set of standards, if you will, a baseline, to use the word used here, on which sort of national and indeed regional standards can be built. Number 7, achieve reporting that is assurable. People need to have confidence in reports, whether or not they're obviously mandatory or indeed in particular voluntary. The assurance of those reports, the accuracy, veracity, etc., is key. Point number 8 for small to medium-sized enterprises, certainly be proportionate and focus on the information that improve business management. So really, focus on what's important and indeed leave out what isn't, particularly for SMEs where cost may be an issue. In number 9, in terms of technology, obviously in terms of tech and tech disruption to a variety of different businesses and industries over the years, let's make sure that we use reference to tech in the right way. Okay? So there's guidance from the ACCA. Let's look forward from there towards integrated reporting. Now, as mentioned at the outset, integrated reporting is a very, very common topic in the SBL exam, and unfortunately in my experience of marking mock exams, sometimes, at least 50% of the time, it's not well dealt with by students. I'm not really sure why. Integrated reporting is a fairly straightforward topic. There's nothing of any technical difficulty within it. So it's really a topic that we should be on top of, given that it comes up regularly, and indeed over and above that, given that it's not that difficult to understand it. But what do we mean by integrated reporting? Well, let's take a look. We're talking about concise communication about how an organization's strategy, governance, performance, and prospects in the context of the external environment lead to the creation of value in the short, medium, long term. Now, a couple of points here that are important. Firstly, concise communication. The information needs to be presented well. The integrated report needs to be presented well. It's about a variety of issues that when you consider traditional corporate reporting or traditional financial reporting, we, in history, in the past, we wouldn't have seen too much mention within a standard annual report, profit and loss balance sheet, cash flow statement, etc., of these areas. And this information is important because, in essence, a business creates value in many, many different ways. Value isn't simply just the difference between revenue and expenses. For example, value is created in terms of training staff. That creates value. Value is created possibly in relation to the local community. So really, what we're saying here in terms of this definition of integrated reporting is that integrated reporting provides more information on important areas, and indeed in the context of the external environment, for users about what companies are doing to create value. Now, note that guidance would suggest it needs to be specific and indeed identifiable. What we mean by that is that the information, or indeed the report itself, needs to be specific. It needs to be able to be seen easily. We need to understand that this is an integrated report, and indeed we need to understand the purpose of it. Now, in terms of sort of possible sort of methods, as it were, it could well be just a standalone integrated report, or it could possibly be some sort of part of another report. For example, generally speaking, a lot of companies would include an integrated report within their annual report. But certainly it should be distinguishable, prominent, and indeed accessible. Okay? So really, in essence, what we're saying in this sort of intro to integrated reporting is that integrated reporting is important. It needs to be, broadly speaking, identifiable in the sense that it's very, very clear that this part, or this document, this part of this report, is an integrated report, and indeed will be produced in line with current best practice. Moving on from there, when we talk about goals of integrated reporting, and I think this is quite important here, this term, integrated thinking. The suggestion here is that reporting in this way, IR, reflects integrated thinking. What does that mean? What does integrated thinking mean? It means really application of the collective mind, the combined mind of those charged with governance. In other words, people involved in running businesses, and indeed the ability of management to monitor, manage, and communicate the full complexity of the value creation process, and indeed how this contributes to the success of the organization over time. That's quite a mouthful, a lot of information. Let me just break that down. Really, what we're saying is that in one sense, an integrated report should help the user sort of get into the mind of the management to understand, how the management plans and does go about creating value and indeed, assuring its future. Okay? Now, the background, I guess, to integrated reporting, outside of obviously the need over the last 30, 40, 50 years for something more than standard financial reporting, is really the IIRC, the International Integrated Reporting Council. Now, what is that? Well, in effect, a council made up of a variety of different relevant and indeed interested stakeholders, from everything from regulators to companies themselves, standard setters in the accounting profession. So we've got about the best group of people on this IRC that we could have in order to assist with the development of integrated reporting over time. And certainly when you look back, let's say for 20 years or thereabouts prior to integrated reporting being in existence, certainly it's come on tremendously since the early days. So next key point for us is in terms of background. So we know what it is, we know what it should be, we know that the IRC are going to provide us with assistance and guidance and standards, etc. What's the background to IR? Well, as mentioned, when we think about historical financial reporting, really financial information is insufficient. When we think about the long-term sustainability of the company, in other words, its existence over the long term, financial information isn't really good enough for numerous reasons. But the first reason is it's historic. It's not forward-looking, okay? So there's the first issue in terms of the creation of IR. So what does IR do? Well, it combines certainly financial information, which is obviously important to businesses, with non-financial information to really maximize value. So really what we're talking about is a document, a report that provides a lot of information really to give the user much more value about how a business creates value. So what are the goals really of IR? Well, firstly, as you would have thought, quality of information. Secondly, to sort of guide towards a more cohesive and measured approach to corporate reporting. And indeed to give people more confidence, about the accountability of people running businesses, of directors, of managers, etc. And indeed people in that stewardship role, people who are really tasked with looking after businesses' assets for others, or for people that actually own them. Let's move on from there. In terms of detail here, the framework, the IR framework, the integrated reporting international framework. So what is that? Well, really what it is a sort of set of principles and indeed content elements. I mentioned up top about guidance. Well, here it is. So in essence, with those principles, those stated principles, and indeed the content elements, the elements that should be included within an integrated report. Remember, this is all guidance because integrated reporting is not mandatory in any way. Linked into that, ideally, any communication, whatever it is, whether or not it's a fully blown integrated report or some sort of release under the title of integrated report, should apply these principles and should, broadly speaking, if it's a full report, certainly adhere to the content elements. Moving on from there, the capitals. Now, this is a key issue. Outside of the sort of introduction definitions and broad characteristics and the guidance from IRC, the capitals are central, or your understanding of the capitals are central. So what are these capitals? And certainly in my experience of dealing with students, teaching this area, looking at mock exams, this capital area does cause some problems. And indeed, very often, unfortunately, within mock exam questions, students don't know all the capitals. They maybe know 3 or 4, but they don't know them all. We need to know them all. But what are they? Well, what we're saying here is that IR is supposed to demonstrate an organization's use of or dependence on different resources and relationships. So in essence, we can call the capitals really different types of resources or possibly relationships in one way. So in terms of a detailed explanation, let's take a look. Now, we know that there are 6. The easiest one, in my opinion, always to deal with is the first one. It's really financial capital. So really, if we were to have in front of us an integrated report now, really what we'd see in the financial section is really details in relation to funding. How does the business fund itself? Has it funded itself differently this year? What are its plans forward in relation to funding and indeed returns to individuals or indeed companies, debt holders, etc. So that's an easy one to deal with. In other words, it's sort of really part of what we've seen before. In terms of the next area, manufactured. Now let's note here that manufactured, in essence, means any physical object that the business or the organization uses to create value. That's literally anything at all. It could be raw materials, it could be the buildings, it could be a factory, it could be equipment, literally anything that is tangible that is used. That is manufactured capital. In terms of area number 3, intellectual. So, we're talking about intangibles. We're talking about know-how, okay? This would include the area perhaps of patents and copyright, etc., etc. But certainly the know-how in the business, some of that will be held within staff and indeed staffing. Next area for us dealing with staff is really human. Okay, now we're not so much talking about the intellectual side, we're talking about skills. We're talking about, the competencies of HR, the people that we employ. Every business is heavily dependent upon its human capital. So we're talking about competencies, capabilities, and indeed experience. Next one for us is social and relationship. So really, as you would expect, this is about how the business interacts with different external stakeholders, whether they're communities or groups of stakeholders, other networks, suppliers, foreign companies, etc., etc. So within a typical integrated report, we would want to see information about perhaps new relationships, about issues in relationships, etc., etc. Final one is natural. So we're really talking about resources here, not least renewable, but also non-renewable resources. So really anything that the company uses in some way, shape or form to create value. So what we want to hear about within an integrated report is, how is the company, how is the organization using these resources? Are they concerned going forward into the future about the ability to replace them in some way, particularly if they are non-renewable? That's a question that needs to be asked. Moving on from there, we've mentioned this word value several times, and this is an area that I think students find on occasion difficult to understand, because when we think about for-profit entities that perhaps are listed and have shareholders, and we think about value, I guess the first thing that springs to mind is the maximization of shareholder wealth. And some students, I think wrongly, simply think that a business creates value and that equals profit. Okay, not quite. I think it means a number of different things, as I touched on up top. So we're really talking about, the value created by an organization results in differences, either increases or decreases, in these capital areas. In other words, the 6 areas above, whether or not that's human or intellectual or manufactured, etc., etc. So really what an integrated report is supposed to do is really show how these areas change as a result of increases, decreases, or perhaps transformation in some kind. Now, in terms of more detail on value creation, clearly, as mentioned, a business creates value for the providers of financial capital. So we're talking about debt holders, in the form of, let's say, interest or interest payments, and also shareholders in the form of dividend return, and indeed indirectly capital growth in shares. But value is also created elsewhere, as mentioned. So I think I gave this example up top. If we spend more on training, then we create value for our staff. Okay? Let's take a look at this little diagram here. This is quite important because really what we're talking about here is sort of guidance in terms of this particular area of value. So when we think about value, when we think about the importance, given what we said so far, of integrated reporting, some guidance here in terms of, I guess, how to do it. First things first, a strategic focus and indeed future orientation. When we think about the report, clearly it needs to be bulletproof in this area of the organization's ability to create value in whatever way it does that, okay? And indeed, it needs to be very specific on the use of the capitals. The capitals are, all 6 of them, pretty comprehensive. I can't think of anything that a business, an organization, would impact upon outside of those 6 capitals. So let's be specific in the report. In terms of the next area, connectivity of information. So what we should do is we should make sure that, linking between different areas is done. Okay, the report should demonstrate how different areas are connected. For example, let's say human with financial. Let's say financial with manufactured. In terms of the stakeholder relationships, I think we're pretty clear on what that means is, how the business, develops and maintains relationships across time. So it should certainly provide information or provide insight into the nature and quality of those relationships. Really give as much detail as you can within reason. Fourth area D, materiality. So really what we're looking to ensure is that the report really discloses information which is significant and indeed important. What we don't want is a lot of information that's really immaterial to the organization's ability to create value. Let's be precise and let's be concise, which leads me to my next area, conciseness. What we don't want to do is overload the user. We don't need superfluous information or irrelevant information, okay? Next area, reliability and completeness. Now, this is an interesting one, and I'm going to touch on this further a little bit later on in this mind map. I mean, certainly we need to ensure that the report reflects certainly all material items, whether or not they're negative or positive, and indeed that it is reliable and indeed free from error. The problem that we have here, as I'll mention a little bit later on, is that yes, we have guidelines, we have guidance from the IRC in terms of content, etc. But let's remember that integrated reporting is not mandatory, it's not law-based, and indeed reports are not audited. More of that later. In terms of consistency and comparability, really what we need to do is to be consistent in our reporting year on year. And indeed, we need to try as best we can, and subject to other variables, to present information in such a way that your integrated report is comparable. Now that's difficult. That is difficult because different companies will report in different ways. So, moving on from there, in terms of the content elements, we have the principles. The content elements are also many and varied, and you'll note obviously this is simply cut and pasted from the ACCA Study Hub. Now, I do think that these two areas are, very, very detailed, but I think it's important for us to run through them in this video. The idea that we would perhaps be tested on either the guiding principles or indeed the core elements in an exam question is probably highly unlikely, but it's good to give us some background information. So what about the elements? What about the content? What should be in a report? Well, broadly speaking, point number one, some sort of organizational overview and indeed bringing in the external environment. Okay, what does the organization do? Okay. In terms of governance, yes, well, we need to know about leadership. We need to know, who's involved, has that changed, and indeed, how is that going to impact the ability to build value over time. The business model is obviously relevant, and that will be included. Risks and opportunities, we know how risks affect a business, and generally speaking, in terms of risk reporting, more often than not, we're looking at sort of downside risks. We're talking about specific risks that can really harm the business or indeed, opportunities perhaps in the environment to create more value over time. How is the business dealing with these risks and opportunities? In terms of strategy and resource allocation, obviously one needs to be careful in terms of disclosure of key or confidential information, or information that would provide perhaps a competitor with some sort of competitive edge. But the bottom line is that we need to talk about strategy. We need to talk about where the business wants to go and indeed what resources it will use to get there. Next area, performance. Certainly, we need to link the financial information within the financial statements, balance sheet, and indeed statement of profit and loss with the business's overall stated strategic objectives, and indeed, the effect of that, or the effect of performance on the 6 capitals. Next area, outlook. I guess this is about the
future, the challenges and uncertainties in terms of strategy and indeed other areas, and how the outlook may change. Is there anything in the future that concerns the board? Last area, basis of preparation and presentation. Certainly, when we think about the presentation of information, it's key. As we mentioned up top, we need to include enough information, but not too much. We need to make sure that it's usable, easy to understand, etc. So that's the content elements. Let's move on to usefulness. Now, on the face of it, given what we've said so far, certainly it would appear to me and probably to you, yeah, this is a good idea. Integrated reports are a good idea. Why? Well, what do? Well, they certainly provide good quality information about value in a number of different ways. That's indisputable. But what about criticisms? Well, first things first, we know that they're not mandatory. So in essence, any company can produce a report, broadly in line with the guidelines and indeed the content elements. But we may be concerned about reliability and credibility. Because, albeit for the fact that we have guidelines and content standards, as it were, there's no one checking. There's no one checking the details of reports or integrated reports that companies are producing. In addition to that, there are really limited information in terms of, performance indicators or metrics for measurement, okay? Very limited information. So, for example, if we're looking for, comparability between different entities, different listed entities, let's say, that's going to be difficult to do because there's no prescribed standards. Final point here is really, this issue of, competitive advantage and indeed the use of information disclosed within an integrated report by other parties, possibly competitors. The difficulty in making full, accurate, transparent disclosure on all areas across the capitals is that information could be used by another, and that may lead to a loss of competitive advantage. So that's a problem. What about auditing? How about the idea that reports could be audited? Well, there's no audit requirement at the moment. There may well be in the future. But notwithstanding that, the guiding principles do suggest two things, as mentioned up top. They suggest that there's a real need for reliability and indeed completeness. Now, the only problem here is, yes, that's a guiding principle, but that could be ignored. It may well be that some integrated reports that are available may be somewhat unreliable, and indeed they may be complete because this is not written in law. There's no specific requirements to produce an integrated report in a specific way. Remember, we're talking about guiding principles and indeed guidance on content elements. So, given that, there's certainly a suggestion by many parties that some sort of, assurance report, either an audit or some sort of check on the information would probably provide some element of credibility to integrated reports. Absolutely. But the problem with that is when we think about let's just say an audit report requirement for an integrated report. Certainly the skill base needed to be able to audit information, which remember is broadly non-financial, is completely different than the skill base needed to audit information that is financial. In other words, would auditors be skilled enough to audit a report such as this? Outside of that, certainly if an audit was in play, if there was a requirement for audits, then we really would need to see a change in the way that customers and indeed companies record information. So, how do they record information, for example, in relation to IP or training, human capital, or indeed natural resources. So this creates a problem and possibly additional costs. Moving on from there, you know, we see integrated reporting as something that is key right now and has been key for some years. But we have already and always had, certainly from my memory, social environmental reports. You know, again, we're talking about impact, aren't we, of the business on society, the community, and indeed the environment. So these are not uncommon. You know, they're not quite an integrated report, but something similar. So let's take a look at social and indeed environmental effects, or indeed how a business can affect an organization, how a business can affect society and indeed the economy. Now, when we think about economic activity, i.e. the economic activity of businesses, I guess broadly speaking, what we're talking about is the production and distribution of goods and services. That's what businesses do, okay? So economic activity in this sense results in production creating consumption of some kind. In other words, consumption of resources. So businesses consume resources in order to be able to produce something, whether or not that's a good or a service. Now, all businesses, all industries are different, but you know it could well be that the resources are renewable or possibly non-renewable. And there's a problem for us in terms of areas such as sustainability, impact on the environment, etc., etc. Now, obviously, there are some solutions. For example, recycling. I understand from the sort of stat within the study hub that a very, very large proportion of all cars made today, all new cars made, is recyclable, something like 80 to 90%. So things can be done, but at the end of the day, where we have economic activity, we have use of resources, we have consumption, and indeed possibly depletion of the world's natural resources. Now, linked into that is this area of footprint, or environmental footprint, EF for short. So what do we mean by that? Well, what we mean is that certainly, an organization where they go about creating an economic activity for the production of goods and services is certainly going to impact upon the environment, in terms of resource use, waste, environmental changes, etc. So really, in essence, what we're saying is that EF sort of concerns the sort of human demand versus the Earth's supply of resources. That's what we mean by EF. So in terms of sort of impact issues, clearly there's consumption, in terms of the production in the first instance, but there's also emissions. In other words, what comes out the other end. Now, in terms of examples of perhaps areas of concern, certainly air pollution and indeed quality. We see that as an ongoing problem in many areas of the world. Certainly water quality, and I guess the big one, perhaps most prevalent, most talked about, certainly these days, is climate or climate change. So a variety of different impacts in terms of EF, that's for sure. So how do we measure this? Well, when we think about a country, so a country's EF, so we're talking in broad terms here, it's certainly going to be impacted upon by the size of the population, by the sort of average consumption, or indeed the amount consumed by the average resident, and indeed the intensity required to make resources, the intensity at which resources are used within that country. Okay? Now, in terms of an organization, well, when we think about an organization, what sort of impact can it have, and indeed on what areas? Well, paper, certainly energy, the use of transport, the use of buildings and the building of buildings, and indeed, of course, water. Okay? Our next area is, I guess, linked into EF, but slightly different. I mean, note that EF is concerned with the environment, with ecology. okay? But what we're talking about here is sustainability and the social side, the social impact. So let's define a few terms. First area for us is social impact assessment. Now, quite a mouthful, Hill, my apologies, but I thought I'd include the whole lot and run through it with you. So what does, when we think about organizations and their impact upon society and social issues, what does that mean? Well, it means sort of analyzing, monitoring, and indeed managing the intended and unintended social consequences of planned interventions and indeed any social change processes invoked by those interventions. So let's stop there. What that means is just looking at and indeed viewing the impact of businesses and organizations on society and indeed on any changes. So primary purpose of social impact assessment, in other words, the activity of looking at how businesses impact upon society, is to bring about a more sustainable and equitable biophysical and human environment. Now, flip side of that really is social footprint method, SFM. So this is really a measurement idea. So it's an approach to measurement and reporting that quantifies the social sustainability performance of an organization. So here we're talking about metrics, okay? We're talking about metrics. Here we're talking about a broad assessment, but here we're talking about some numbers, okay? Now, further to that, this area here is important, anthrocapital. Okay, you may or may not be familiar with this. If you've looked through the study hub, you will be. So obviously, when we think about EF, environmental footprint, we're talking about impact upon natural capital. We're talking about the world's resources, et cetera, et cetera. Now, when we think of SF, social footprint, we're talking about people. We're talking about communities. And this can be measured through something referred to as anthrocapital. So really, anthrocapital, for that, read capital created by people, okay? Now, there's three main elements to anthrocapital as detailed here. Now, I've taken this directly from the study hub. The first side is human capital, i.e. health, knowledge, experience, et cetera, okay? People. The second side is social capital. So we're talking about networks, shared interests, activities, social intercourse, etc. Okay, and the third area is constructed capital. So we're talking about buildings, physical infrastructures, roads, utilities, etc., etc. So you can see that there certainly is a difference between EF and indeed SF quite clearly. Okay, next area for us is just reference to SDGs now, and indeed sustainable development, okay? So what do we mean by that? What do we mean by sustainable development? Really, what we're talking about is sort of quality of human life, okay? And indeed the balance between the quality of human life and what companies are doing and impacting, or how they impact. So really, what we're saying is, yes, we want to improve the quality of human life, but we want to stay within the carrying capacity of supporting ecosystems. That's what we should be doing, and that's what businesses should be helping to do. Sustainable development, okay? Next area here, an interesting one, and this is a sort of a method of reporting, as it were, triple bottom line. Now, let me just move this across so that you can see that. Triple bottom line, in terms of a definition, it's really about measuring and indeed reporting on corporate performance against these three main areas, economic, social, and environmental benchmarks, to show improvement or to make a more in-depth evaluation. So really what we're saying is, profit is one area, or economics is one area. Yes, we need to make a profit. We have shareholders holding shares in companies for a return. But let's also report in relation to what we're doing on the social side and indeed the environmental side. Okay? So that's the definition. So, when we think about TBL, I guess we can sort of view it, I guess, as a sort of a reporting mechanism or device. We can include information in relation to how we're performing in reports, in annual reports. And outside of that, TBL, if we do record information in relation to performance in those three areas, it can help decision makers, it can help the board make decisions. And if we don't report, then it's certainly more difficult to make decisions in those areas. So there are several positives to this, absolutely. Some more key issues on this area in terms of broadly advantages and indeed disadvantages. Absolutely, certainly TBL assists with transparency. The more information that we're providing in relation to performance in those areas, the better our information is, broadly speaking. As mentioned, if we're recording our performance, our decision making has to be better. And then linked into that, certainly if our decision making is better, it's more than likely that we improve relationships with key stakeholders, particularly those who are interested in that area of social and environmental impact. But what about flip side? What about disadvantages to TBL? There are some. There's no guidance really on how you should report. That means that certainly to some extent usefulness and indeed in particular comparability is different between businesses. Finally, costs. If we're reporting on two significant areas, social and environmental, on top of the financial side or economic side, then certainly there will be costs attached. Now, in terms of the sort of examples, let me just go to here 1 second, just get this diagram up for you. So this sort of brings it all together, indicators of a sort of impact, as it were. So you have several key areas upon each of the banners. This, to some extent, this will include the standard sort of financial reporting in terms of how the business creates profits, etc., but also other areas of importance to stakeholders. For example, stimulus to local economy. Do they purchase locally? Outside of that, perhaps dependent upon on imports. On the social side, certainly several issues here, not least employment, or perhaps employment in the local community. On the environmental side, obviously things like carbon footprint, emissions, etc., are absolutely key. Okay. Next area for us is sort of on a slight tangent. I don't see Section 4 internal management systems as being critical to our success, but nonetheless, if we're thinking about ways in which companies can sort of act or indeed manage their impact upon the environment, upon ecology, upon society better, then management systems or management information systems are certainly important. So what do we mean by management first off? Well, the organization and control of a business in some way, shape or form. In terms of a management system, certainly we're talking about, excuse me, some sort of way of running a business, some sort of structure, to running a business, that everyone is clear about who's responsible for doing what, when, how, why, and where. Now, where we have good management, we will have a good management system. And when you think about the areas that we've discussed so far in this particular video, you can think certainly that it's not simple to be able to report, for example, on your impact upon the local community, your impact upon areas such as sustainability or emissions. It's not simple to do that. You do need a proper management system. And indeed, linked into that, when we talk about integrated management systems, even better. Because what this suggests is that an IMS, with a sort of a holistic an approach across the board is the best route forward. Because really what that does is consider all issues at the same time, trying to balance out different objectives. So in essence, we're talking about linking. Okay, standards. Now, again, this is sort of linked, I guess, in one way to what we've been discussing regarding management. We need assistance to be able to deal with the areas that modern day business needs to deal with. Standards can help us. What do we mean by standards? Well, broadly speaking, sort of codes of practice or specifications that really set out perhaps methods, processes, practices, which when effectively implemented, ensure that products, services, or systems provide good quality, performance, safety, and reliability. So we're talking about something to compare our practices with, or indeed use as a basis for our practices. Now, in terms of more detail here, we know that, or you're probably familiar with the 14,000 family of international process standards for environmental management. These are just some examples, and really these provide certainly a range of pretty bulletproof guides and indeed bulletproof documentation to assist businesses in this area of standards for environmental management. In terms of the requirement, let's say for ISO 14001, what this does, or what the suggestion is within this particular ISO, is that businesses should be measuring environmental performance on all activities, products, and services, and indeed continually improve this through monitoring. Okay. What about the contents? The contents of ISO 14001. Well, broadly speaking, general requirements, environmental policy, implementation and operation, corrections, checking and corrections, and indeed management review or over review. Okay. Moving on from there, now when we think about the benefits of, let's say, having a standard, let's pick ISO 14001, there are a myriad of benefits, starting with the idea of compliance. It provides a sort of a benchmark to comply with, and that's something that we can use to promote ourselves. We are complying with this particular standard. In terms of conformance, each standard will provide a sort of a blueprint, a guide for individual companies to conform to. That's the whole idea of a standard. In terms of competitive edge, really what we're saying is that the use of, for example, ISO 14001 will provide an opportunity for companies and organizations to get or gain a competitive edge, particularly when competitors are not adhering to the standard. In terms of improved management, some might argue this is just more work, but certainly these standards, these process systems, these guidelines are extremely well laid out, and one has to suggest that there is a strong chance that management can be improved in this particular area by using a standard such as ISO 14001. Now, in terms of credibility, I guess linked into competitive edge or competitive advantage, again, this is the type of thing that companies will use to promote themselves and attain increased credibility. The standards will also be sort of updated from time to time, so this certainly encourages improvements, or step-by-step improvements over time. Next area, integration. Really what we're talking about there is integrating different areas of the business, particularly if more than one standard is used. This is a blueprint, if you will, for success in different areas. And there are a range of standards covering many, many different areas for an organization. In terms of reducing public liability, we're really talking about insurance there, or insurance costs. You will find that insurers will reduce premiums if a business is seen to be using these standards. So that's a drop in costs. And in terms of enhanced reputation, again, linked with up top, i.e. credibility, competitive edge, etc. Certainly, this is the type of thing that would be promoted by the company to enhance their reputation, as opposed to individual companies or competitors who are not using these standards. Okay, last area here, this is an alternative to ISOs, as mentioned up top. In other words, the previous section, this is the sort of European approach to eco-management. Now, I've said see study text here. I think more than one is overkill. I don't think that we need to have really good knowledge of both. We need to know that this exists, but I'd encourage you to look at the study text in relation to EMAS. But my favored option would be the ISOs for sure. So I think the previous section is more important than this for sure. Okay, so that really includes everything to do with corporate reporting. I hope you found that useful. As mentioned from the outset, do take a very, very good look at integrated reporting, because based on everything that we've covered in this particular Chapter 6 video, that is the area that I would put high on my list of priorities across the board in this exam, in this syllabus. Okay, so thanks for listening. I hope that your studies are going well. Please do join me